Right now, the global money supply is surging at an unprecedented pace, and this swelling tide of cash may be hiding a dangerous bubble ready to burst. In this video, you'll discover how Washington's push for China to buy American semiconductors may be more than just a trade tactic. You'll see how this strategy connects to a broader economic crisis, a ballooning money supply, fragile liquidity, rising debt, and weak economic foundations that few analysts are openly discussing. Recent policies, financial flows, and global trade tensions are combining to create unseen pressures on markets, pressures that could erupt suddenly and ripple across the world. Stay with me, because by the end of this video, you will understand why the chip war is not just about technology, why America's flood of money into markets may be sowing the seeds of collapse, and what all of this could mean not just for Wall Street or big tech, but for everyday people everywhere. Welcome to the channel. Hit subscribe now if you want to stay informed about these serious issues. The conflict between the United States and China over semiconductors runs far deeper than a simple trade disagreement. Washington is pushing hard for China to buy more American-made chips, not just to sell products, but to assert control over a technology considered vital to global power. For the U.S., semiconductors are a lever for national security, trade influence, and the preservation of technological dominance. Since export controls began tightening in 2022 and have continued to expand, the U.S. has restricted China's access to advanced computing chips and essential manufacturing equipment. These measures aim to limit China's ability to independently produce next-generation chips, especially those critical to artificial intelligence, defense systems, and high-tech industrial applications. At the same time, the larger economic context in the U.S. looms. The country faces a flood of money supply, rising public debt, and inflationary pressures. These financial strains create urgency behind Washington's push for China to buy semiconductors. Every sale supports American tech firms, strengthens dollar-denominated revenue, and helps maintain fragile economic equilibrium. Limiting China's access to chips also pressures Beijing to accelerate domestic production, but dependency remains tilted toward the U.S., giving Washington leverage in technology and trade. For China, the stakes are enormous. The country imports hundreds of billions of dollars in semiconductors every year, more than it spends on oil, making chips one of its largest imports. The U.S. push intensifies tension, forcing China to make a delicate choice: continue buying American chips under pressure, or accelerate domestic production and risk confrontation. The decisions China makes today could reshape global chip markets, trade flows, technological leadership, and the balance of economic power for years to come. China's response has been measured and strategic. Beijing is not outright refusing U.S. chips, but it is also not fully complying. Instead, China is carefully balancing its need for advanced foreign chips with its goal of developing domestic alternatives. This cautious strategy allows China to avoid severe retaliation while signaling that it will not be fully dictated to by U.S. policies. For U.S. chip makers, this partial compliance creates immediate uncertainty. Orders from Chinese companies, including government-backed buyers, are smaller and slower than anticipated, disrupting revenue streams and production forecasts. Some firms are experiencing inventory buildups, while others struggle to meet contractual obligations, straining supply chains. The ripple effect is visible across component suppliers, logistics networks, and semiconductor equipment manufacturers, all tightly interconnected in a highly globalized market. The consequences extend beyond individual firms. Delays in chip supply affect electronics, automotive production, communication infrastructure, and emerging technologies like AI. When one major buyer hesitates or limits purchases, it sends waves through global production schedules. Inventory pressures rise, equipment utilization drops, and financial forecasts must be recalibrated. Markets start pricing in risk, and investment decisions become more cautious. At the same time, the massive money supply in the U.S. amplifies the risk. Excess liquidity can temporarily prop up markets, but it also fuels potential bubbles. Asset prices rise beyond sustainable levels, creating a false sense of stability while underlying fragilities accumulate. Should a major disruption, like slowed Chinese chip purchases, coincide with a liquidity squeeze or rising interest rates, the effects could cascade rapidly across global finance. In short, this chip war is not just about trade or technology. It is a convergence of geopolitical strategy, financial pressures, and global supply chain vulnerabilities. What happens in this sector could influence investments, prices, employment, and economic stability worldwide. The push for China to buy American chips is both a tool of leverage and a potential trigger for larger systemic stress. Stay tuned, because understanding these connections is critical. The next moves by Washington, Beijing, and major corporations will not remain local. They will ripple across global markets, energy flows, and everyday life for millions. If this video helped you understand the bigger picture, hit the like button and subscribe for more analysis on global finance, technology, and emerging economic risks. In the United States, early signs of stress are beginning to emerge across the financial system. Liquidity has tightened as companies adjust to delayed payments and reduced demand from China, creating a subtle but growing strain. Stock markets, particularly in the tech sector, have responded with heightened volatility. Prices of major semiconductor companies fluctuate sharply, reflecting investor uncertainty over how long China will maintain its cautious stance and what that could mean for U.S. profits. Analysts are increasingly warning that if this partial compliance continues, growth for the broader tech industry could slow, potentially affecting employment, capital investment, and innovation pipelines. At the same time, the broader economic context amplifies these tensions. The U.S. money supply remains historically high, contributing to persistent inflationary pressures. Government debt obligations continue to climb, further straining fiscal flexibility. When combined with disruptions in chip sales, these factors create a fragile environment where even minor shocks can produce outsized effects. Consumer electronics, automotive production, and industrial technology sectors all rely heavily on a stable supply of chips. Any uncertainty in China's buying patterns immediately filters through production schedules, pricing, and global supply chains, creating ripple effects across multiple industries. Investors, policymakers, and corporate leaders are watching these developments closely. Partial compliance from China forces U.S. firms to reconsider global strategies, hedge risks, and potentially accelerate moves to diversify markets or shift manufacturing closer to home. Smaller suppliers feel the pressure more acutely, as they lack the scale and financial flexibility to absorb sudden changes in orders or delayed payments. This unfolding scenario underscores the interconnectedness of global trade, where strategic decisions by a single country can ripple rapidly through supply chains, financial markets, and the broader economy. The bubble at the heart of this tension is not a simple market fluctuation. It is a complex mix of excess liquidity, growing public debt, and risky financial positions. Over the past decade, the Federal Reserve has injected enormous amounts of money into the system to stimulate growth, creating vast reserves of cash circulating through markets. This abundance of liquidity has fueled asset inflation across sectors, from real estate to equities, encouraging companies and investors to take risks they might have avoided under normal conditions. At the same time, U.S. government debt continues to rise, adding fragility to an already stretched financial system. Washington's push for China to buy American semiconductors adds another layer of pressure to this delicate balance. The government is attempting to prop up key sectors of the economy and maintain the flow of revenue into dollar-based markets. While this may temporarily support U.S. tech firms, it also concentrates risk in a single area. Should China slow or delay purchases, vulnerabilities hidden within over-leveraged companies, inflated valuations, and overstretched supply chains could be exposed very quickly. The potential for disruption is real because the U.S. economy rests on interdependent layers of debt, liquidity, and global trade relationships. Any interruption in the expected flow of money, whether due to slowed chip sales, a sudden drop in investor confidence, or tighter credit conditions, can trigger cascading effects. Banks and financial institutions exposed to high-risk assets could face sudden losses. Investment funds dependent on continuous market growth may experience sharp declines. Even consumer confidence could waver, reducing spending and slowing economic activity further. Adding to the pressure, inflation remains elevated, forcing the Federal Reserve to maintain higher interest rates. Borrowing becomes more expensive, particularly for companies carrying large debt loads. This reduces their capacity to invest in growth or manage unexpected shocks. The combination of excessive liquidity chasing fewer tangible returns creates instability. Asset prices are inflated, and underlying risks are masked by artificial market support. The longer these conditions persist, the greater the potential for sudden and severe corrections. In short, the U.S. economy faces a complex and interconnected challenge. Partial compliance from China in the chip market may seem like a localized issue, but its effects ripple across global supply chains, financial markets, and everyday life. Every delayed purchase, every fluctuation in liquidity, and every shift in investor confidence matters. The risk is not hypothetical. It is embedded in the system, waiting for the right catalyst to trigger a wider financial shock. Staying informed, monitoring global supply chains, and understanding the hidden pressures in the tech and financial sectors is now more important than ever. Rising debt obligations and concentrated market pressures are creating a perfect storm. Even a small disruption can amplify across the entire system, spreading risk far beyond the initial source. Layered on top of this are risky investments, including speculative tech startups, leveraged buyouts, and complex financial derivatives. Many of these positions rely on assumptions of steady growth and uninterrupted demand from global markets, particularly China. When a major buyer hesitates or shifts strategy, valuations are suddenly reassessed, triggering cascading losses across sectors. The interconnectedness of global finance means that a localized problem can quickly become systemic, transforming a theoretical risk into a real and looming threat to U.S. economic stability. The tension between the United States and China over semiconductors is already sending shockwaves far beyond their borders. Semiconductor chips form the backbone of modern technology, powering everything from smartphones, computers, and industrial machinery to cars, airplanes, and even medical equipment. When a major buyer like China alters its purchasing behavior, It creates immediate ripples throughout global supply chains spanning Asia, Europe, and North America. Manufacturers relying on steady chip supplies face production delays, rising costs, and the need to adjust inventories, factors that slow growth and disrupt carefully planned projects. Financial markets are highly sensitive to these developments. Investors watch semiconductor companies, tech stocks, and broader market indices closely, knowing that any slowdown in U.S.-China trade could spark sharp market reactions. Reduced investor confidence and increased volatility in global currencies can quickly follow. Economies dependent on exports to China or on the U.S. dollar as a reserve currency may feel indirect pressure as trade patterns shift and financial flows become less predictable. Countries like South Korea, Taiwan, Japan, and some European nations, which play pivotal roles in the semiconductor ecosystem, are particularly exposed. A disruption in demand could ripple through their economies, affecting manufacturing, employment, and investment. The potential long-term consequences are substantial. Should China continue to resist or delay purchases, prolonged partial compliance could push the country to accelerate domestic chip production, invest heavily in self-reliance, and reduce dependency on U.S. technology. Over time, this may shift the balance of global technological power, creating new competitive pressures for American companies. At the same time, industries and countries built around stable U.S.-China trade flows would need to rethink supply chains, diversify partners, and adapt to a more fragmented global market. Uncertainty encourages strategic stockpiling, cautious investment, and slower innovation cycles. Companies may delay or cancel projects, avoiding risks until trade patterns stabilize. Financial institutions could adjust lending, hedging, and investment strategies to account for potential shocks from disrupted chip demand. The highly interconnected nature of global trade means even minor shifts in purchasing behavior can amplify into broader economic consequences, affecting not only technology but also energy, transportation, manufacturing, and consumer goods worldwide. In essence, the U.S.-China semiconductor tension is more than a bilateral issue. It is a global stress test, revealing vulnerabilities in trade networks, financial systems, and technological dependencies. Nations reliant on chip imports or dollar-based transactions may need to adapt quickly, while companies that fail to anticipate change risk sudden losses. The pressure could fundamentally reshape global tech leadership, trade alliances, and capital flows, creating a world where decisions made in Washington and Beijing ripple across continents with unprecedented speed and intensity. One of the most critical factors to watch in this unfolding situation is the Federal Reserve's response. How it balances interest rates, liquidity, and inflation control will determine whether the system absorbs the shock or magnifies it. Global investors, policymakers, and corporate leaders are watching closely, aware that the outcomes of this conflict are not confined to boardrooms or stock exchanges. They affect jobs, products, prices, and daily life worldwide. Interest rate changes, quantitative tightening, or other monetary policies can directly influence liquidity, borrowing costs, and the flow of money through markets. A sudden increase in rates could put additional strain on already leveraged companies, while a pause or reduction might temporarily stabilize investor confidence. Updates on U.S.-China trade are another critical signal. Announcements of new agreements, restrictions, or delays in semiconductor purchases can immediately shift market expectations, causing fluctuations in stock prices, currency values, and corporate forecasts. Chip export numbers themselves provide a concrete measure of demand and supply dynamics. Sharp declines in shipments to China or unexpected slowdowns can reveal cracks in global trade that may escalate quickly. Signs that a bubble might burst are often subtle at first, emerging across multiple sectors simultaneously. Rapid drops in stock prices of major tech firms, sudden inventory surpluses, or liquidity shortages in financial institutions can all act as early warning signals. Rising corporate debt default rates, delayed payments, and a slowdown in venture capital investment are additional indicators of systemic stress. Even movements in commodity prices, semiconductors, metals, or energy can hint at shifts in market confidence before a larger correction occurs. Conversely, stabilization signals might include steady or rising chip orders, stronger than expected corporate earnings, or coordinated monetary and fiscal measures supporting liquidity. Everyday people and investors could feel the impact long before broader economic headlines reflect it. Consumers may see higher prices for electronics, cars, or home appliances due to constrained chip supplies and disrupted production schedules. Inflationary pressures could intensify if companies pass on these costs. For investors, volatility in tech stocks, ETFs, and other semiconductor-linked markets can affect retirement accounts, portfolios, and short-term trading strategies. Even seemingly unrelated sectors, automotive, industrial equipment, and communications technology, may experience delays, price hikes, or temporary shortages, directly affecting businesses and households alike. The combination of monetary policy shifts, trade developments, and chip supply fluctuations creates an environment where vigilance is essential. Small changes in one area can cascade through supply chains, financial markets, and daily life. Investors must weigh risks carefully, and individuals need to be aware of how global economic pressures can influence prices, job stability, and personal finances. In today's interconnected world, the consequences of a bubble or market correction are rarely isolated, making it critical to monitor these key indicators to understand how they could shape the economy and everyday life in the coming months. At the center of this unfolding scenario, the United States is applying intense pressure on China to buy American semiconductors, using trade and technology as leverage to maintain global dominance. China's response has been cautious and strategic, purchasing selectively while heavily investing in domestic production to reduce long-term dependency. Meanwhile, the U.S. faces growing economic risks from a swelling money supply, high debt levels, volatile markets, and fragile supply chains. The tension over chips is more than a trade issue. It is a test of financial stability, technological leadership, and global economic balance. Is this the start of a bigger collapse, or just another chapter in the global tech war? Only time will tell, but the stakes are enormous. The ripple effects of these decisions could reach far beyond Wall Street or Silicon Valley, touching daily life in households and businesses worldwide. Stay alert, pay attention to developments, and recognize that global tech, trade, and finance are interconnected in ways that directly affect everyone. If you found this video insightful, make sure to like it, leave your thoughts in the comments, and subscribe to our channel for the latest updates on global trade, technology, and economic developments. Stay informed, because the next wave of change could affect everyone, whether you realize it or not.